Stock market history is full of ups and downs, but some crashes have left such deep scars that they are forever etched in history. Get ready for a journey through time, where we will present to you the 5 biggest stock market disasters that have shaken global economies. Number 1. The Wall Street Crash of 1929. The Wall Street Crash of 1929, also known as the Great Depression, was one of the most devastating financial events in history. It began on October 24, 1929, a day now referred to as Black Thursday, when panic selling triggered a massive drop in stock prices on the New York Stock Exchange. Over the next few days, the market lost about $30 billion in value, an astronomical amount at the time. The crash wasn't just a single event, but a series of sharp declines, culminating on October 29, 1929, when millions of shares were traded as investors scrambled to salvage what they could. The immediate aftermath saw banks failing, businesses closing, and unemployment skyrocketing. This financial turmoil led to a global economic downturn, marking the beginning of the Great Depression, which lasted throughout the 1930s. Contributing factors included over-speculation, excessive use of leverage, and a lack of regulatory oversight. The crash exposed the vulnerabilities of the economic system and led to significant reforms in financial regulation, including the establishment of the Securities and Exchange Commission, SEC, to help prevent such a disaster from happening again. The Wall Street crash of 1929 remains a stark reminder of the perils of unchecked financial speculation and the importance of market regulation. Number 2. Black Monday in 1987. Black Monday, which occurred on October 19, 1987, stands as one of the most significant single-day stock market crashes in history. On this day, the Dow Jones Industrial Average plummeted by a staggering 22.6%, marking the largest one-day percentage drop ever. The crash was not confined to the United States. Markets around the world experienced similar declines, making it a truly global financial event. The causes of Black Monday were multifaceted. Contributing factors included overvaluation of stocks, computerized trading algorithms that exacerbated the sell-off, and a lack of liquidity in the market. Investor panic also played a crucial role, as the rapid decline in stock prices led to a vicious cycle of selling. The crash wiped out billions of dollars in market value within hours, sending shockwaves through the financial system. In the aftermath, policymakers and financial institutions took significant steps to prevent a recurrence. The U.S. Federal Reserve injected liquidity into the market, and new regulations, such as circuit breakers, were introduced to halt trading in the event of significant market drops. Despite the severity of Black Monday, the market rebounded relatively quickly, and the lessons learned from the crash have shaped modern financial market regulations and practices. Number 3. Dot-com bubble in 2000. The dot-com bubble, which peaked in 2000, is one of the most famous examples of overvalued technology stocks. In the 1990s, investors feverishly bought shares in internet and technology companies, often ignoring their profitability. This massive interest led to astronomical stock price increases and created a bubble. The peak occurred on March 10, 2000, when the Nasdaq Composite reached its historic high. Following this, stock prices plummeted sharply, as investors began to doubt the value of many internet companies. By 2002, many firms had lost all their value and went bankrupt, including well-known names like Pets.com and Webvan. The burst of the dot-com bubble had a profound impact on the economy, causing massive losses for investors and leading to layoffs in the tech sector. Despite the damage, some companies like Amazon and eBay survived and became technology giants. The dot-com bubble remains a warning about the risks of speculative investing and the importance of realistic company valuation. Number 4. Financial crisis of 2008. The financial crisis of 2008 was one of the worst economic disasters since the Great Depression. The crisis began in the United States with the collapse of the subprime mortgage market and the subsequent failure of major financial institutions. The most notable example is the bankruptcy of Lehman Brothers on September 15, 2008, which caused panic in global financial markets. The causes of the crisis included excessive lending of risky loans, complex financial products like mortgage-backed securities, MBS, and a lack of regulation. When the housing market bubble burst, home prices fell, and many borrowers were unable to repay their mortgages. This led to massive losses for banks and financial institutions holding these toxic assets. The consequences of the crisis were catastrophic. Millions of people lost their jobs and homes, while the global economy entered a deep recession. Government interventions such as the Troubled Asset Relief Program in the United States were necessary to stabilize the financial system. The crisis led to significant changes in financial sector regulation, including the adoption of the Dodd-Frank Act, which aimed to prevent such a disaster from happening again. The financial crisis of 2008 remains a stark reminder of the dangers of irresponsible lending and insufficient regulation of financial markets. Number 5. COVID-19 pandemic crash in 2020. The COVID-19 pandemic crash in 2020 was a sudden global financial crisis caused by the rapid spread of the coronavirus. Lockdowns and travel restrictions led to a dramatic economic slowdown. On March 16, 2020, the Dow Jones Industrial Average saw its largest single-day point drop in history, falling by 2,997 points. Panic selling occurred as investors feared long-term economic impacts. Major industries like travel, hospitality, and retail were heavily disrupted. Supply chains broke down, consumer spending dropped, and unemployment rates soared. Governments and central banks responded with massive fiscal stimulus packages, interest rate cuts, and asset purchase programs. In the U.S., the Federal Reserve took emergency actions to support financial markets. Despite the shock, markets began to recover quickly due to these interventions and the gradual reopening of economies. The COVID-19 pandemic crash of 2020 remains a key event, showing the global economy's vulnerability to sudden shocks and the need for swift policy responses. We hope you enjoyed this video and learned something new about the biggest stock market crashes in history. Whether it's speculation, greed, or unpredictable events, history shows us how fragile financial markets can be. Don't forget to subscribe to the channel for more interesting videos. What do you think? Are we heading for another crash in the future? Share your thoughts with us in the comments. Goodbye.